Have you ever wondered if there is a deadline for when you need to start taking money out of your retirement accounts, or if you can just leave it there forever? Understanding the rules around when you must begin withdrawing funds is a crucial part of smart retirement planning. For most individual retirement accounts, known as IRAs, and employer-sponsored plans like 401ks, there are specific age limits set by the Internal Revenue Service, or IRS, for when you must start taking distributions. Generally, for both traditional IRAs and 401ks, you are required to begin taking money out when you reach age 73. This is known as your required minimum distribution, or RMD. The core reason behind these rules is that the government wants to ensure it eventually collects tax revenue on the money you have saved tax-deferred for decades. These accounts grow tax-free or tax-deferred during your working years, but once you reach a certain age, the IRS mandates that you start withdrawing and consequently paying taxes on those funds. The required minimum distribution amount is calculated based on your account balance at the end of the previous year and your life expectancy, as determined by IRS tables. This mechanism helps balance the benefit of tax-deferred growth with the government's need for future tax income. To navigate these age limits effectively, you will want to understand the distinctions between account types. For example, Roth IRAs do not have required minimum distributions for the original owner during their lifetime, offering greater flexibility. However, inherited Roth IRAs generally do have RMD rules for beneficiaries. When planning your withdrawals, start by identifying the type of retirement accounts you hold. Then, calculate your RMD for each applicable account, consulting with your financial institution or a financial advisor to ensure accuracy. You can choose to take out more than the RMD, but you must take at least the minimum amount each year once you hit the age 73 threshold. One insider detail to remember is the Secure Act, which adjusted the RMD age from 70.5 to 72, and then the Secure Act 2.0 further pushed it to age 73 for those turning 70 to after December 31st, 2022. For those turning 74 in 2033 and beyond, the age will increase to 75. These changes were made to reflect longer life expectancies and allow people more time for their savings to grow. Also, if you are still working for the employer who sponsors your 401(k), you might be able to delay your 401(k) RMDs past age 73 until you actually retire, provided you are not a 5% owner of the company. Ultimately, understanding the age limits for IRA and 401(k) withdrawals empowers you to make informed decisions about your retirement income. By knowing when you need to start taking money out and how these rules apply to your specific accounts, you can avoid potential penalties and strategically manage your tax obligations, securing your financial well-being throughout your golden years and potentially preserving more wealth for your loved ones.